Compared with its peers, Free Squirrel sales margins have performed relatively well, fluctuating between 25% and 30% year-round. Although there's still room for development compared with the Heinlein company, like Lifan, according to the company's announcement, it is currently making sufficient preparations for the annual festival in the next year, so it is expected that the company's profitability will be enhanced in the future and the financial indicator will rise at that time. Okay, the next part we will give some information of the operating capacity, and in this section we mainly focus on two current index. The one is the inventory turnover, and the other is the accounts receivable turnover. As we can see the left-hand side picture, the Free Squirrel's inventory turnover ratio took a qualitative leap in 2023, improving to 25 times per year, giving an increase of almost 33% compared to the previous corresponding period. And for the retail trade industry, this metric should easily be 6 to 18 times per year, and the Free Squirrel's performance is about the upper end of this guidelines range, suggesting that its inventory liquidity is strong, which is conducive to generating more revenue for the company. And we always give some characterization of the accounts receivable turnover rate among the companies. Accounts receivable turnover rate retail trade industry generally requires more than 6 times. And we can see the Best-Star, the Free Squirrels, and the Lifan have shown a downward trend in this indicator since 2019, but it's basically higher than the industry average, reflecting the relatively high operating efficiency. And next, we will see something about the short-term solvency, and we also choose two index to give some analysis. The one is the current ratio analysis, and the other one is the quick ratio analysis. As we can see in the left-hand side picture, it shows the comparison of the current ratio among the three companies. To sum up, the current ratio of Free Squirrels has a decreasing trend with the industry as a whole in 2019 to 2023, but it can still maintain a relatively high level in 2023, so indicating a strong short-term solvency. And next, we will focus on the quick ratio analysis. And the picture on the right-hand side shows the comparison of the quick ratio among the three companies. Generally speaking, we believe that the companies are safer when their quick ratio equals 1. And the Free Squirrels shows an upward trend in quick ratio from 2019 to 2023. It starts to be greater than 1 in 2022, entering a relatively safe area. And in 2023, this indicator converges with other comparable companies in the industry. Okay, so let's give the information about the long-term solvency. In this part, we choose the gearing ratio analysis. To sum up, in 2019 to 2023, Free Squirrel's long-term solvency becomes stronger compared with other companies in the same industry. The gearing ratio reflects the ratio of capacity provided by the creditors to all the capital. The lower the ratio, the more guaranteed the company's debt repayment and the safer the loan is. In 2019, the value of this indicator for the Free Squirrels is 60.85%, while in the 2023 it decreases to 54.65%, but it is still slightly compared to the industry. Okay, so in the last part, we gave a year-based profit forecast by Pearson, and in the previous section, we analyzed the financial situation of three squirrels and compared with companies in the same industry. We can preliminarily conclude that the three squirrels has excellent performance in terms of the revenue capacity, the profitability, and the solvency. And the company has high operational efficiency and strong anti-risk ability. Therefore, we believe that in the future, the performance of three squirrels will be even brighter. Based on this conjecture, we used Python to do a regression analysis on the company's net attributable profit and made a forecast for the next 5 years for this financial indicator. The final results are that in 2024, it will reach 339 million, and in 2025, it will reach 361 million and 384 million in 2026 and 407 million in 2027. And lastly is 429 million in 2028. So that's all the information about this section. So next, let our other partner to give a summary of the whole presentation. That's all. Thank you.
Let's look at the analysis of development capability. Development capability reflects a company's growth rate and potential for expansion. In this report, development capability of three squirrels is analyzed using revenue growth rate and net profit growth rate. Data presented in these charts indicates that the revenue growth rate of three squirrels has significantly declined fluctuations. In 2050 and 2060, we can see the impact of e-commerce development on revenue growth. At this time, a high revenue growth rate could be achieved with relatively low sales expenses. In 2070, with the diminishing e-commerce dividends, three squirrels face challenges. Between 2080 and 2090, the company's investment in physical stores gradually paid off. In 2020, the repeated outbreaks of the pandemic greatly limited the supply of logistics capacity, making it impossible for offline stores to operate normally. Thus, the company's revenue sources were not effectively secured. This led to a decline in three squirrels revenue in 2020 and 2021, resulting in a negative revenue growth rate, indicating a problem with the company's growth capability. Comparing with the two other companies from 2015 to 2019, Three Squirrels always had the highest revenue growth rate, indicating that Three Squirrels grew rapidly and had a promising development momentum in the early stage of the new retail business model. However, compared with the industry, Three Squirrels' revenue growth rate has recently fallen to a lower level. Three Squirrels led to develop products that can better attract consumers. From 2023 to the present, Three Squirrels proposed a cost-effective strategy, compressing the supply chain costs to benefit consumers and adopting a D+N channel model. This revenue data shows that the decline in revenue basically stopped in 2023. In the first 3 quarters of 2024, the revenue performance has already shown a good growth trend compared to the previous years. As shown in the charts, the net profit growth rate of three quarters after the transformation to the new retail model is far lower than before, indicating that the company's growth capability has encountered problems during the development process of the new retail business model. In 2019, showing that the various measures in the new retail business model consumed a large amount of funds, leading to a negative net profit growth rate. The net profit growth rate rebounded in 2020 and 2021 thanks to establishment of alliance factors and the layout of offline distribution, which effectively reduced the cost of products in production and transportation through the entire supply chain. Comparing with Besto and Laifen, the net profit growth rates of the three companies fluctuated significantly with various degrees of negative growth. In 2022, there was significant negative growth, and in 2023, there was a trend of recovery and growth. In the first three quarters of 2024, the gross profit and net profit growth rates were relatively high due to the gradual effectiveness of the company's D+N channel layout. Overall, Three Squares' net profit growth rate is average in the industry, and its development capability needs to be improved.
Hi everyone. Now let me introduce the summary of our group work. Well, the report provides a comprehensive analysis of Three Squares, a leading Chinese snack brand, focusing on its business model, industry position, and both financial and non-financial performance. Established in 2012, Three Square has transformed into a digital-first company, utilizing e-commerce and omni-channel strategy to achieve significant growth, with annual sales passing 10 billion. And we focus our analysis on three parts. The first one is introduction, which mainly introduces the background of the development of the Three Squares. The second part is industry analysis, which includes sport evaluation and assessments of the company's life cycle. The third part, we discuss about the financial metrics, such as profitability, operational efficiency, and growth capacity, are thoroughly examined alongside non-financial factors like R&D investment, market share, and customer satisfaction. It highlights the company's strengths, such as strong brand presence and innovative marketing strategies, as well as weakness, including heavy dependence on domestic market and seasonal fluctuation in sales. And we also use Python to explore the opportunity for growth, including health trends and international market expansion. While threats encompass economic uncertainty and raw materials cost volatility, Three Squares has the potential for sustained growth through digital transformation, product innovation, and strong focus on sustainability. Additionally, a financial analysis covering the year 2014 2023 indicates effective cost management and profitability, with forecasts suggesting continued positive performance in the coming years. Overall, Three Squares is well positioned to maintain its market leadership and expand its global presence. And here is all of our presentation. Thank you for listening.